In just a 24-hour window, retail traders panic sold nearly 22,000 bitcoins.
Yeah, which is just a massive amount.
Right. And they didn't just sell. I mean, they sold at a huge loss, entirely driven by fear.
Exactly.
So, welcome to this very special edition of Bitcoin Deep Dives by MyCryptoParadise, because today we are taking you right into the inner circle.
You really are.
We're doing an exclusive behind-the-scenes breakdown of the latest market analysis from our very own Paradise team trader, Simon.
And it is a fascinating read.
It is, because human behavior is, it's wired to panic when the market drops. But inside MyCryptoParadise, we don't gamble, we calculate.
That's the core philosophy right there.
Exactly. So today's deep dive is designed to elevate you, the listener. We're going to decode Simon's professional trading mindset, explore the behavioral biases that make the masses lose their shirts, and show you exactly how the pros navigate all this chaos.
Yeah, because 22,000 Bitcoins sold at a loss. I mean, that is a staggering amount of wealth just handed over to the market.
Just given away.
Right. But from a behavioral science perspective, it's actually entirely predictable.
How so?
Well, human biology is basically hardwired to panic when we feel a sudden loss of control or, a loss of resources. The masses look at a cascade of red candles on a chart, and their amygdala just fires up.
Like a physical threat.
Exactly. They treat a drop in price like a literal physical emergency. It's fight or flight.
Which is crazy when you think about it. And the analysis uses this really interesting biological metaphor to explain this. Simon describes the market as having a breathing pattern.
I love that analogy. It's so accurate.
Right. The idea is that markets just don't move in straight lines. They inhale and they exhale.
It is a really helpful visualization for market mechanics. Because in structural trading terms, we're talking about impulse waves and corrective waves.
Okay, let's unpack this a bit. So the inhale is the impulse wave.
Yeah, an impulse wave, the inhale, is a large, powerful movement in the direction of the primary trend. I mean, it takes effort, it takes volume, and it really drives the price up.
Okay, and the exhale?
The exhale is the corrective wave. It's a natural, totally necessary pullback.
So right now, with Bitcoin coming down from that $74,000 high.
Structurally speaking, the analysis argues it's just simply exhaling.
Okay.
Simon maps this out as a 5-wave motive structure, which is then followed by an ABC zigzag correction.
Right, the zigzag.
Yeah, and it's a completely normal, healthy market function that is required to establish support before the next leg up.
But wait, if this is just a normal exhale from 74,000, why is the retail crowd acting like they're having a severe asthma attack?
That's a great way to put it.
Seriously, if it's healthy, why the sheer terror?
Well, because there's this massive psychological disconnect between what the market is structurally doing and what the retail trader is emotionally feeling.
Ah, okay.
This is a textbook case of recency bias combined with an extreme focus on immediate results.
Right, because retail traders, especially the ones who, just jumped in recently, they base their entire emotional state on their immediate P&L.
Yes, their profit and loss statement. They don't have a broader multi-year framework at all.
So they just look at the price dropping from 74,000?
And their recency bias projects that downward trajectory infinitely into the future. Their brain literally screams, it's going to zero.
Oh, wow. So they hit the panic button just to stop the psychological pain?
Exactly.
Yeah.
Now, they might get lucky in the short term by, catching a random pump, but they completely lack the stomach and the systemic framework for long-term market mechanics.
Which totally explains the 22,000 Bitcoins sold at a loss. But hey, for every seller, there has to be a buyer, right?
Always.
Those coins didn't just vanish into thin air.
No, they didn't. What's fascinating here is that while the retail crowd is suffocating in this exhale, the smart money, the long-term holders, the institutional algorithms, they are calmly absorbing all of that panic selling pressure.
Wow. And the analysis points out that the Paradise team had actually already distributed a portion of the Bitcoin near the top.
Yeah, right around the $69,000 to $72,000 mark.
So they secured profits when the herd was greedy.
Precisely. Which means they protected their capital. And that is the absolute fundamental difference between the gambler and the professional inside MyCryptoParadise.
Capital preservation over FOMO.
Always. Capital preservation over the fear of missing out.
But, taking a short position or distributing at the top when the market is euphoric sounds great in hindsight, but it also sounds incredibly risky.
It can be, if you don't know what you're doing.
Right, because if you're wrong, you get run over by the trend. So how does a professional like Simon actually execute trades in this environment?
Well, he doesn't guess. He hunts.
He hunts. I love that. The sources mention the market acts like a predator, right?
Exactly. You have to understand that the market often acts like a predator, and liquidity is its prey.
Okay, so what does that look like in the current landscape?
Well, because of all this retail panic and short-term, highly leveraged positioning, there's a massive cluster of retail stop losses and liquidation levels sitting right now between $69,000 and $69,700.
Wait, let's slow down and really look at the mechanics of that. Why does a cluster of stop losses act as a magnet for the market?
Now, okay, let's walk through it step by step. If you're a retail trader who is panicking, you might decide to heavily short the market, betting the price will go down.
Right.
But to protect yourself from infinite losses, if the price suddenly spikes up, you place a stop-loss order just above the recent highs.
Okay, makes sense.
Now, what is a stop-loss on a short position? Mechanically, it is a market buy order.
Right, because you have to buy the Bitcoin back to...
To close your short position, yes.
Ah, okay.
So now imagine thousands of traders putting their automated buy orders in the exact same tight price zone between 69,000 and 69.7.
That's a ton of orders.
It creates a massive pool of guaranteed liquidity. And the market makers and large institutional algorithms, they naturally gravitate toward these pools.
So they'll often intentionally push the price up just to trigger those stop losses.
Yes.
Triggering a liquidation cascade.
Precisely. When those stops hit, it forces thousands of traders to automatically buy at market price.
Oh, wow.
And that sudden rush of buying pressure provides the perfect, highly liquid environment for the smart money to sell their heavy bags into without crashing the price.
That is brutal. So once the smart money has sold into that artificial pump, the market just continues its real trend downward.
Yep. The retail traders who got stopped out were just liquidity prey.
So what does this all mean for you, the listener? How do you avoid being the prey in this scenario? Because if the market might pump to 69.7 just to liquidate shorts before continuing its downward trend, how do we trade that?
Well, Feynman actually did trade that beautifully. While he ultimately sees a long-term third cyclical wave taking us to 169,000.
Which is a massive target.
It is. But his immediate tactics are distinctly bearish. He recently led a highly successful scalp with the VIP team.
Right, the short position.
Yeah, taking a short position at the 72,500 limit breaker and writing it all the way down to the 66,000 target.
That is some clinical execution. But the whole landscape still feels like a psychological battlefield. And the source material highlights another tactic used in this hunting process, spoofing.
Oh yeah, spoofing is rampant.
There was that example of a $60 million sell wall sitting at $67,700. But the analysis warns us not to necessarily believe it. How does spoofing actually work?
Spoofing is basically a psychological weapon. It's used by massive players to manipulate the order book and, by extension, retail emotion.
Okay.
Let's say a massive player actually wants to buy Bitcoin cheaply. They will place a gigantic sell order, like that $60 million wall high up on the order book, but with absolutely no intention of ever letting it execute.
They just want people to see it.
Exactly. They want the retail trader to look at the order book, see this terrifying $60 million wall of supply, assume a massive dump is coming, and panic sell their coins at the current lower price.
That is so manipulative.
It is. And as soon as the actual price gets close to hitting that fake sell wall, the massive player just cancels the order.
Wow.
They use the illusion of supply to drive the price down, allowing them to accumulate on the cheap.
And conversely, you have the opposite tactic, right? Iceberg orders.
Yes.
I assume that means most of the order is hidden beneath the surface?
You got it. If a massive institutional buyer wants to accumulate, say, $500 million worth of Bitcoin, putting that order on the public books would cause the price to instantly skyrocket before their order could even fill.
Well, front running.
Exactly. So they use an algorithmic iceberg order. It only shows a tiny fraction, maybe $1 million, to the public.
And as soon as that small piece is filled,
A new piece magically appears behind it.
sneaky.
Very. The smart money hides their true intentions with icebergs, while broadcasting fake intentions with spoofing to herd the retail crowd.
Okay, but if the order book is full of optical illusions, how on earth do you differentiate a fake move from a real structural shift?
That's where you have to combine technicals with sentiment analysis across different time frames.
Like the fear and greed index.
Exactly. The sources use that as a great example. On the 4-hour chart, the index recently touched a score of 20, which indicates extreme fear.
Right, which usually signals a potential bounce because sellers are exhausted.
Usually, yes. But if you zoom in and look at the 1-hour chart, the index was sitting around 60, which is slightly greedy, or at least neutral.
Meaning the panic isn't actually systemic yet.
Exactly. It tells a professional that there isn't enough universal extreme panic across all time frames to fuel a massive, sustained reversal.
So what did the pros do?
They wait. They don't try to catch a falling knife. Professionals wait for the market to prove itself by reclaiming a historical resistance level and clearly turning it into support before they ever push the buy button.
Which brings us to a really fascinating part of the analysis, because Simon is currently using these tactical bearish scalps, shorting the limit breakers on the way down. But for the macro picture, he is waiting for a massive opportunity to buy the ultimate cyclical bottom.
Yes, he is.
And to find that bottom, he's not looking at retail stop losses anymore. He's looking at the biggest forced sellers in the entire ecosystem.
The Bitcoin miners.
Yes, the miners. But this is such a crucial piece of the puzzle, the miner's dilemma.
It really is. Because during a protracted bear market, or even a deep corrective phase, there comes a mathematical breaking point for mining operations.
Right, because mining Bitcoin requires massive overhead, electricity, expensive hardware, facility cooling, paying your staff.
Exactly. And when the price of Bitcoin drops below a certain threshold, the cost to mine a single coin becomes higher than the value of the coin itself.
Their operations just cease to be profitable.
Right. They literally can't afford to keep the lights on.
And because they have real-world bills denominated in fiat currency, they are forced into capitulation.
Yes. They have to sell their mining rigs at a huge discount, and more importantly, they're forced to dump their strategic, multi-year Bitcoin reserves onto the open market just to avoid bankruptcy.
We saw this massive, agonizing miner capitulation in the 2018 to 2019 bear market, right?
We did, and we saw it again in late 2022. It is a historical hallmark of a true market bottom.
The weakest, over-leveraged miners are forced to sell their supply to the strong hands.
Exactly. And Simon has actually mapped out the target reaccumulation zone for this current cycle based on this exact phenomenon.
Yes, the analysis has it perfectly boxed in between $55,000 and $44,000.
That's the zone.
And the material lists a bunch of technical reasons for this, and honestly, to a casual listener, it sounds like alphabet soup.
It really does.
We've got historical price action, Fibonacci retracements, the volume profile, visible range, bearish MACD divergence on the daily time frame. Can we translate some of this?
Sure, let's unpack the volume profile visible range, or VPVR, because it is one of the most powerful tools pros use.
Okay, VPVR.
Standard volume bars at the bottom of a chart just tell you when trading happened. But VPVR is plotted on the side of the chart, on the y-axis.
Right.
It tells you at what price the most trading happened historically. It creates a heat map.
So it shows where the market previously agreed on fair value.
Yes. And when you look at the VPVR, there's a massive bulge of historical trading volume sitting right at that $44,000 level.
Ah, okay.
That means there are significant buyers positioned there, acting like a structural safety net.
Now, combine that with the bearish MACD divergence on the daily time frame. MACD measures momentum, right?
Yes. And divergence happens when the price of Bitcoin is still making lower lows, dropping steadily, but the MACD indicator starts making higher lows.
Meaning the downward drops are losing their steam, the sellers are getting exhausted, even though the price is still bleeding.
Precisely. So when you have historical support, massive volume nodes, and momentum exhaustion, all aligning in the exact same price bracket where miners mathematically have to capitulate.
It creates a highly probable target for a generational bottom.
Exactly.
But here's where it gets really interesting. Think about the psychology here. Recognizing that a drop to 44,000 is a mathematical probability doesn't automatically stop your heart from racing when you see your portfolio bleed.
No, it doesn't.
If we actually hit $44,000, the mainstream news will be absolutely screaming that crypto is dead.
Oh, the sentiment will be apocalyptic.
Right. So if you are sitting there listening to this, how do you find the courage to buy heavy when the whole world is terrified?
Well, if we look at the core professional mindset highlighted in the sources, you realize something profound. It's not about courage.
And about courage.
No, because courage implies you are feeling intense fear, but forcing yourself to take a massive risk anyway. Professionals don't rely on courage. They rely on systems.
The MyCryptoParadise systems.
Exactly. By identifying the exact mechanics of what is happening, the transfer of coins from weak, capitulating miners to strong, smart money, you take the emotion completely out of the equation.
So you aren't buying because you are brave.
No, you are buying because your system dictates that the probabilities of a bottom have aligned.
Taking emotion out of the equation sounds great in theory, but actually executing it brings us to the ultimate difference between the retail gambler and the professional trader.
It really does. It's all about fundamentally rewiring how you view risk.
Which is where the poker analogy comes in, right? The analysis stresses thinking purely in probabilities, not certainties.
Yes, because the human brain craves certainty. We want an absolute answer. Will it go up or will it go down?
Of course we do.
But the market owes you zero certainty. A professional trader operates exactly like a professional poker player.
Okay, explain that.
In poker, timing your bets matters, but position sizing matters infinitely more. A pro poker player doesn't go all in on every single hand.
Right, because that leads to gambler's ruin.
Exactly.
Break down gambler's ruin for us.
Gambler's ruin is a mathematical concept that shows if you risk too much of your total bankroll on single events, it is a statistical certainty that you will eventually hit a losing streak long enough to wipe you out completely.
So if you risk 50% of your capital on a trade, you only have to be wrong twice to lose everything.
Right. Whereas professionals might only risk 1 or 2% of their capital per trade.
So when the probabilities give you a small, calculated edge, you make a small bet.
Exactly. You're paying a small premium to see the next card, which in trading means waiting for the next piece of price action or a daily candle close.
And as new cards are revealed, the probabilities change.
Yes. If the new card strengthens your hand, say Bitcoin reclaims a key moving average, you might increase your position size.
And if a market weakens?
Then you actively manage the risk. You move your stop loss to break even or take partial profits. You are actively managing probabilities in real time.
But the hardest part, the thing that I think destroys most retail traders, is what happens when the probabilities are against you, or when the market is just chopping sideways.
You fold.
It just folds.
In trading, the absolute hardest lesson for gamblers to learn is that no position is a position.
Yes. Sitting on your hands, just holding fiat or stablecoins, requires immense discipline.
It really does, because retail traders feel like if they aren't actively in a trade, if their money isn't moving, they are somehow missing out.
I want to pose this directly to you, the listener. When was the last time you traded just out of boredom?
Or out of FOMO.
Right, or FOMO. When is the last time you forced to trade just to feel the action, instead of waiting patiently for your true mathematical edge to present itself?
It raises a vital point about how we process loss. Simon shares a trading mantra in the analysis that encapsulates this professional detachment perfectly.
Oh, I love this quote. It's, I detach from outcomes. Losses are just feedback that sharpen my strategy, and wins are the result of disciplined execution.
It's brilliant. Losses are just feedback.
It completely reframes the experience of a red day. It's no longer a personal failure. It's just data for your algorithm.
And if we connect this to the bigger picture, that is exactly why we operate like a hedge fund. Protecting capital isn't just a catchy phrase.
It's the cold mathematical reality of survival.
Exactly. You have to survive these brutal corrective exhales, these engineered liquidation hunts, and these agonizing minor capitulations so that you actually still have your capital deployed when the macro trend eventually resumes.
Right. If you gamble and lose your stack chasing a fake pump at 69,000, you don't get to participate in the real bull run to 169,000 later.
It is survival of the most disciplined.
Wow, we have covered incredible ground today dissecting this analysis.
We really have.
We looked at the market's breathing pattern, understanding that this current drop is structurally just a healthy exhale, even if retail feels like they're suffocating.
Yep.
We explored the mechanics of liquidation cascades, how stop losses become liquidity pools, and how market makers hunt that herd.
And we also unpacked the minor capitulation zone between $55,000 and $44,000, translating the technical data to recognize it not as a time for fear, but as a systemic high-probability reaccumulation target.
And most importantly, we broke down the probabilistic poker player mindset that definitively separates the Paradise team from the retail gamblers.
It's all about that discipline.
Now, before we wrap up this deep dive, I want to leave you with a final thought to mull over on your own.
Okay, what is it?
Well, we spent all this time talking about controlling human emotion, how retail panic fuels the smart money, and how professionals use systems to eliminate fear and greed from their execution.
Right.
But think about this. If Simon views losses purely as feedback and completely detaches from the outcome, What would happen to your portfolio if you completely removed your ego from the market?
Oh, that's a great question.
Imagine a world where a red day doesn't ruin your mood, but simply refines your personal algorithm. If the entire ecosystem currently relies on the smart money hunting the emotional mistakes of the retail herd, what happens when you decide to stop being emotional prey?
A market with perfect discipline. That would fundamentally alter everything.
It really would. Something to think about the next time you look at a red candle and feel your pulse rise. Thank you for joining us for this exclusive session of Bitcoin Deep Dives by MyCryptoParadise.
Trade safe and protect your capital above all else.
Stay disciplined, trust the probabilities, and we will catch you on the next deep dive.